Overnight, something quietly snapped in the world's gold system. The ships kept moving, the vault doors kept closing, and the West woke up to 0 ounces left on the screens that really matter. The signals are strange and scary. Record metal leaving New York and London, delayed data, silent banks, and almost all of it ending up in one place, China. This isn't a rumor. It looks like the same kind of pattern we saw before past money crises, when gold vanished from public vaults just before the rules of the game were changed. Why would the biggest players drain real metal from the West right now, and what do they know that ordinary investors don't? Because if China has quietly cleaned out the vaults, the story is no longer about price, it's about power, and who controls what's left of real money. Stay with me to the end of this video, because once you see the full trail, you won't look at your savings or the dollar the same way again. If you want to keep getting these deep dive investigations, make sure you subscribe, hit like to support the channel, and watch this story all the way through so you don't miss what happens when the gold is gone. For years, Western gold vaults were treated like bottomless wells. London, New York, and Swiss banks held the metal that backed big trades, central bank swaps, and EF products. On paper, those wells still look deep, but when we follow the physical shipments, a different picture appears. Customs data from Switzerland, the world's main gold refiner, shows a steady river of bullion leaving for the East, especially China. Bars are melted, recast, and shipped out. At the same time, official vault reports in London show holdings dropping by thousands of tons since 2012. Gold ETFs in the US and Europe report outflows, even while retail demand in Asia keeps rising. The metal is not vanishing, it is moving. One clear irregularity stands out. Inventories fall, yet prices do not fully signal tight supply. In past decades, such heavy demand would have pushed gold far higher, much faster. Today, the paper market seems calm, while the real bars are getting harder to find. Data updates arrive late, are revised, or quietly discontinued. History has shown this pattern before. In the late 1960s, Western central banks tried to defend the dollar by selling gold from public vaults. The London gold pool drained itself until it finally broke in 1968. The official story was stability. The data showed stress. So the question hangs over today's numbers. Who is really running out of metal and why now? The answer keeps circling back to one buyer and one destination, China. If Western vaults are the bathtub, China is now the drain, pulling metal away faster than it can be replaced. China does not buy gold the way most countries do. On the surface, the story looks simple. The People's Bank of China, the central bank, reports its official gold reserves every few months. The numbers rise slowly in small, careful steps. It all seems normal and controlled. But when we compare these reports with real-world flows, something does not match. China mines more gold than any other country. It imports large volumes through Hong Kong, Shanghai, and directly from Switzerland and Africa. Add those tons together and the total is far higher than the central bank admits. The extra gold is the missing piece. Analysts believe this hidden metal is being stored in places that do not have to report to global bodies like the IMF. State-owned banks, wealth funds, and even entities linked to the military can hold gold off the books. It is like water diverted into underground pipes instead of flowing through the main tap everyone can see. The pattern is not new in history. Before World War I, several European powers quietly built gold war chests that did not show up in public balance sheets. Official numbers looked calm, even as real power shifted behind the scenes. One red flag today is the steady withdrawals from the Shanghai Gold Exchange. The volume suggests heavy domestic buying, yet only a fraction appears in official reserve updates. So who owns the rest? Is it private demand, or a slow, silent transfer into a state-controlled hoard? Just as earlier signals hinted, the more gold that disappears into China's opaque system, the more pressure builds on the already draining Western vaults. In today's gold market, most promises are made on paper, not in metal. Banks, funds, and traders buy and sell contracts that say gold on the screen, but no bar changes hands. These contracts can be created quickly, in almost unlimited volume. Real bullion cannot. This gap between paper and metal is where the main risk now hides. On Comex in New York, the number of open gold contracts often equals dozens of times the deliverable ounces in the vaults. In simple terms, it is like selling 50 tickets for every seat in a small theater. As long as almost nobody asks to sit down, the system works. But if many players suddenly demand delivery, someone will hear the words, "no metal available." A clear red flag is how inventories have trended. Registered Comex stocks, the portion actually available for delivery, have fallen sharply at several points in recent years, even as trading volume hit records. London's unallocated system shows a similar strain, with more and more claims resting on the same pool of bars. History offers a warning. Before the gold window closed in 1971, foreign governments could still ask the US to convert dollars into metal. As claims rose and the underlying gold stash fell, the pressure became unbearable. The official price stayed fixed, right up until it snapped. The open question today is simple. Who will be left holding only paper if a real shortage appears? With China draining physical gold from Western vaults, every new contract written without metal behind it is another bet that no one will test the system. Just as earlier patterns suggested, that is becoming a dangerous assumption. For years, China was one of the largest foreign buyers of US Treasury bonds. Those bonds are IOUS from the US government, and they sit at the center of the dollar system. Holding them meant trusting that the existing order would last. That picture is slowly changing. Official US data shows China's treasury holdings peaking around 2013 and then starting a long, uneven decline. Month after month, the total steps lower, even as China's trade surplus and foreign earnings stay large. The question is simple. If the dollars are still coming in, where is the value going instead? At the same time, we see a rising pattern of gold imports, metal bought from miners, and purchases of other hard assets like energy fields and mines. It looks less like random diversification and more like a gradual swap. Treasuries out, bullion and resources in. It is like trading a stack of paper promises for bricks you can actually hold. A clear red flag is that this shift is happening without open conflict in markets. Yields on treasuries do not fully reflect the loss of a major partner. That calm surface is odd, given the scale of China's move. History offers an echo. In the 1960s, France and other nations quietly exchanged their dollars for US gold step by step until the Bretton Woods system broke in 1971. Then, too, the system looked stable, until it was not. No one outside Beijing knows the exact target mix China wants between bonds and metal. But just as earlier signs suggested, every treasury sold and every bar added pushes the world one step further from a dollar-only future. Gold crises rarely arrive out of nowhere. They usually grow in the shadows, as small policy moves and quiet market strains build into something larger. When we line up today's signals against earlier shocks, the rhythm feels familiar. In 1933, the United States banned private gold ownership and revalued gold higher soon after. The public story was stability, but the real motive was to repair a broken banking system with a silent devaluation of the dollar. In 1971, Nixon closed the gold window, ending the right of foreign governments to swap dollars for US gold. Again, the message was control. The data showed a simple fact. Too many claims, not enough metal. In both cases, pressure built first in the flows. Gold moved out of official vaults faster than it came in. Foreign holders began to doubt the promise that their paper was as good as gold. Prices, rules, and even laws changed later, after the metal had already moved. Today we see another version of that pattern. Western vault stocks are thinning. China and other Asian buyers keep adding metal. Yet central banks and global bodies still insist the system is stable. The red flag is the mismatch between words and flows. The 2008 crisis adds a more recent echo. Back then, complex mortgage products looked safe on balance sheets until trust vanished and no one wanted to be the last holder. Gold today plays a similar role for some investors, a hedge if faith in paper claims weakens. The open question is how far this can go before rules shift again. If too much gold ends up in places like China, will Western leaders change the game, just as they did in 1933 and 1971, to protect what remains? Stress in a financial system often shows up first in small price gaps and odd trade routes. That is exactly what we see as more gold moves quietly toward China and other parts of Asia. One clear sign is the frequent price premium in Shanghai. Gold there often trades a few dollars, sometimes tens of dollars, above the London price. In a normal balanced market, the same bar should cost almost the same in both places. This steady gap hints that real demand in Asia is stronger than the paper price in the West admits. Trade data shows another twist. Switzerland, once a simple hub between Western buyers and sellers, now sends most of its refined gold to Asia and the Middle East. The United Arab Emirates and Turkey have become important transit points. Bars leave Western vault systems, change shape, and then reappear, locked inside new networks that are harder for Western regulators to track. It is like watching money leave a bank and move into private safes. Central bank behavior adds more tension. Since 2022, global central banks have been buying gold at the fastest pace in decades, led by emerging markets. This mirrors the pattern after the 1997 Asian crisis, when countries rushed to build large currency reserves. Back then, the shield was US dollars. Today, part of the shield is metal. The red flag is that many Western institutions still rely mainly on financial hedges, derivatives, and swaps, while Asia quietly builds a base of physical gold. If a major shock hits currencies or bond markets, which side will be better protected, those holding promises or those holding metal? That unanswered question links every small price gap, every strange shipping route back to the same core story. Gold is moving, and with it, leverage and power are moving too. 0 ounces left almost never means the world has no gold. It usually means something more specific and more dangerous. There is no free metal left in a key vault at the current price. For people who want delivery now, the bars may still exist, but they are already promised to someone else. In the modern gold system, the same ounces can be pledged again and again. Banks lend and swap gold the way they lend cash. It is like renting the same car to several drivers, all for the same weekend, hoping they will not all show up at once. As long as most players roll over their contracts, nobody notices. The trouble starts when many ask, "Send me the bar." At that moment, a vault can hit 0 ounces of deliverable gold even if it still holds metal on paper. The real choice becomes clear. Default on delivery, pay cash instead, or quickly raise the price to pull metal out of hiding. In 1968, when the London gold pool broke, markets had to close for days. because official sellers could no longer meet demand at the fixed price. It was an early version of a 0 ounce moment. No gold at that price from those sellers. Today, odd signs already appear. Retail buyers in some countries see delays, high premiums, or out-of-stock notices, even when futures prices look calm. The red flag is simple. The shelves look thin, while the screen says everything is fine. If China keeps pulling bullion out of Western vaults, the risk grows that a big player will one day test the system and find only promises. The open question is what that moment forces into the open. A higher gold price, new rules, or a clearer view of how much power has already shifted. In the end, every signal in this investigation points in the same direction. Real gold is leaving the open, Western-controlled system and flowing into tighter, more opaque hands, with China at the center of that shift. Western vault stocks are shrinking, paper claims keep growing, and the gap between spot prices and real-world demand is widening like a hairline crack in glass. History shows how these stories usually end. In 1933, 1968, and 1971, leaders did not admit the problem until the metal had already moved and the old rules could no longer hold. What looked like sudden change was really the final stage of a long pattern. Too many promises, not enough backing. Today's quiet drain toward China, the steady selling of U.S. treasuries, and the record pace of central bank gold buying are all parts of that same script. None of this means the dollar vanishes tomorrow or that markets collapse overnight. But it does mean the foundation under the current system is shifting, inch by inch, toward a world where trust in pure paper is weaker and control over real reserves matters more. A 0 ounces moment in one key vault would not just be a technical failure, it would be a public admission that the old comfort story no longer matches the facts. Something big is already unfolding in slow motion. When the world finally notices, it will not be asking where the gold went. It will be asking who has it now and what new rules they decide to write.